let's dive deeper into the action with our markets reporters. Renita, get us started.
Hey there. Just as Caroline was talking about, we had quite a bit of volatility at the start of this fourth quarter. So I wanted to take a look at gold because it's a safe haven. It's actually gaining more than 1% today, feeding off of more signs of economic weakness. Now, the latest data shows that U.S. private companies' payrolls rose less than forecast. Hiring in August was downwardly revised, and a stronger dollar and occasional indications of a possible thaw in the trade war have actually pressured gold lately, but gold is still up to close to 17% so far this year. And with this recent unexpectedly low data, investors fear that more signs of economic weakness could push the Fed to keep cutting interest rates, likely sending investors to safe havens like gold. This is the second consecutive day of gold's rise after U.S. manufacturing gauge posted the weakest reading in a decade. Abigail Taylor, pardon me.
Yeah, Renita, I'll take it from here, and I'm taking a look at the SOX index, which is really interesting. It's actually outperforming the broader markets, only off about 1.6%, even though the S&P, as we saw, closed lower by about 1.8%. This is a little bit unusual. Typically, when we get concerns about trade and global growth, you would see some of these chip-heavy sectors like the SOX really underperform the market and create a sell-off given their big exposure to international and China. And today, that is not the case. We do know that the SOX has been bumping up around the 1,600 level, creating a triple top, but then the 50-day moving average has created a really bit of a support line there. So there's a lot of push-pull, at least today, within the SOX market. Going forward, as we relate this back into the S&P 500, I wanted to take a look at a long-term chart of the two. I think the big concern here is that the SOX has peaked twice before the S&P 500, and then the S&P 500 rolls over. So now that the SOX has peaked and started to roll over, there are still big concerns here that if you don't see strength in these chip makers, it's really hard to make the case for the broader market to move higher. Abigail?
Well, Taylor, not surprisingly, with stocks selling off today and yesterday, we do have a bit of a rally for bonds. In fact, over the last 5 days, take a look at this. The 2-year down, giving up 20 basis points, the 10-year 14 basis points. So investors really bidding up the short end a bit more. That, of course, has the effect of steepening the yield curve. Paul Ciano over at Bank of America Merrill Lynch, a top II-ranked technical analyst, he would probably be encouraged by this. He joined us on Smart Charts a couple of weeks ago and presented this chart. This is the 2 10-year spread going back several decades, and every time it's gone below zero or inverted on a monthly basis, it's gone sharply below, with the one exception that he has circled here back in 1998 around the long-term capital crisis, where there was a couple last blips to the upside, a risk-on blip. Paul Ciano said that if we could see this 210 spread on a monthly basis at the end of September close above zero, we could see a similar situation right now with the 210s, Joe, back closer to 10, 11 basis points. Perhaps you're right. Even though we have this volatility to the downside today, maybe there is going to be a little bit more of a risk on, or at least volatility up and down in the weeks and months ahead.